What's up, YouTube? Welcome back to another video. In this video, we're gonna break down the key characteristics behind my A setups. We trade liquidity, supply and demand, and Wyckoff over here, guys. That is the concepts that we use, and I'm gonna showcase you guys this trade right here that I took on ACAD about last week. And we're going to talk about the characteristics behind this trade and why this trade was an A setup. And we're just going to break it down. All right, guys. So here we are on a fresh chart. And we're going to go back in the replay feature. And we're going to use this to talk about what we're using to identify this setup and how we identify our key supply zones, our key demand zones, and why we should be looking for which one. Okay, so the first thing we got to start off with, guys, is our direction. We need our directional bias. As you can see right here, this is basically a simplified version of my rules that are inside of my trading plan. Something for me to look at. I suggest you guys do this too. Something for you to look at as you're trading live, so you just have it right there, so you can always make sure you're keeping up with your trading plan and with your strategy, and you're actually following your rules. Okay, so first thing we got to find is bias. Usually I am on the 1 hour time frame. Now sometimes I do start out on the higher time frame, like the daily or the 4 hour, just to get an overall direction of the market. The 1 hour time frame is usually what I'm using to look for my supply and demand zone specifically. The next thing we want to identify is our structure points. So we're going to start right here with the latest structure point. You always want to start with the latest structure point that you can identify. Okay, guys, we do not need to be going back in time all the way here from August to try to find out what's going to happen here. Okay, that time has already passed. We need to understand what's going on right now. What we need to identify is what is our latest structure point. All right, and the best way to identify that is looking for what got invalidated, what high got invalidated, or what high is holding, what low is holding. Okay, in this case right here, we can see this high got invalidated. So now I can start that reference structure. So I know from this high to this low, and then we invalidate this high. So that means now we have a low to this high, which is just a huge wick, to a low, to the next high, which was made, let's see, high, low, to which was made right here. Okay, 1, 2, 3. Yeah, from this low to this high that was made. And then let's draw our fibs from low to high to the wick. We can see we traded back into 50%. And that is a rule of thumb for me if you don't understand structure. So from low to high, low to high. Okay, so let me explain this to you guys. If we have a high and then we have a low, and then this low breaks this high, this is our low that creates this high because we invalidated that previous high, right? Basic structure. The main thing for me is, in order for this low to be considered a new low, we have to pull back into 50%. So I always draw my fibs from the low to the high, and I always want it to come back at least to hit the 50%, so then we can continue our structure. So that means this low made this high, this low made our whatever new high. Now the main thing here is, if this, let me edit this real quick for you guys, if we do not hit that 50%, so for example, say we're going up, low, up, low, up, and let's say we create something like this, right? So you guys can see we have what? Low, create a high, low. So from this low to this high, trade back into 50%. From this low to this high here, we did not trade back into 50%. So that means that this here is still our low. We just have not made a new high, right? Because this high did not trade back into 50%. So this low is still our key low that is holding our structure. All right. So if this market still continues to go higher and then it pulls back, then we will draw our fibs from that low to what the new high. And if that high makes it to 50%, and let's say the market makes it to 50%, and then we go back higher, now we can say from this low to this high, from this low now to the next high, right? That's how we do it, guys. We want to make sure that this low here is already established because we invalidated this high. Now, whatever high that the market creates, it needs to make it back into the 50% for it to be an established low, like for right here. So this was not a low, right? This was not a key low. Okay, this is our key low because we made it back into 50%. And that is key for you guys to understand. All right, I'm showing you guys all the confluences behind this trade, and I want you guys to be able to get this strategy down packed and understand how we're taking these simple A setups. Now that we have our structure, right, we're gonna zoom in here. We have low, we have a high, we have this low, which makes it, yep, this high makes it back to this 50%. So we have a low now. Now, what I want you guys to understand is the reason why this wasn't a high is because we didn't break the high, okay? That's why this wasn't a high, all right? So now we have this low here to our next high, which was created about right there. All right, you guys can see from this low here, this is not a high because we didn't break the high, right? We didn't break the previous high. So this low creates this high now, once we have invalidated the high. And then you guys can see from this high to this low, we made it back into 50%. So now we zoom in, and here's our structure now. And then we're coming up into the trade. So let me go back in replay mode and let me show you guys exactly where that was. Let's go right here. What is our latest structure leg? Okay, so we have this low, this high, this low that made this high, and then this low here makes this high. Okay, now that we found our latest leg, which is gonna be here, and I'm just gonna keep it simple. This low creates this high. Now that we have identified our latest leg, we have identified our bias, we know here that we should be looking for demand zones. Demand zones means you're looking for a buy. Supply zone means you're looking for a sell. Why are we looking for a demand zone here, guys? Well, go back, we have our Wyckoff here on the higher time frame, so we know that buyers are in control of this market at the moment. And then our structure, so we have our higher time frame direction, and then we have our 1 hour structure, which we're trading for our intraday, right? We're trading our structure. We see that structure is bullish. So when structure is bullish, that means we should be looking for demand zones. When structure is bearish and you're in a bearish structure, that means you should be looking for supply zones. So in this case right here, we're in a bullish structure, so we're looking for demand zones. All right, now we have to identify those areas. And then we go to step 2. Now the main setup that we're gonna focus on here today, guys, is the A setup, right? This is gonna be the highest probability setup. Now we need to validate a proper demand zone. Where do we buy this market from? Okay, so now we're looking at our structure. We see that this low is what made this high. Okay, well, we're gonna need to identify within this leg here for our next trade to continue this market higher. So basically we want to follow the trend, right? That is going to be the best thing here, guys, with supply and demand. When you're trading supply demand, make sure you can identify the trend. Are we in a buyer's market? Are we in a seller's market? Now we're going to identify our confluences for that A setup to identify a demand zone. Okay, so first we need to have a manipulation / mitigation, right? A manipulation of liquidity. So if you guys don't understand what that means, you can go check out one of my older videos about liquidity and understanding what liquidity is, or search it up on YouTube. You'll definitely find somebody that's talking about liquidity. Okay, so in this case right here, we need to identify a manipulation / mitigation, and I'll talk about that the other half later. So what is our manipulation? We need a manipulation of liquidity. So we need the market to take out some lows. Where do we see this market has taken out some lows? Within this leg. We're not talking about this price action here, guys. We're talking about what inside of here can we trade from. Okay, so when we're looking at this and we're scanning this leg, we're looking for that next area we want the market to buy from, to react from. Here is our manipulation, right? We can see down here, we have this candle, right? We have this 1 hour candle right here that sweeps these lows, right? We go underneath these lows. This is a manipulation, guys. So boom, we can see we sweep these lows right here. All of these lows right here, you can tell. If I go on lower time frame as well, let's go on the 15-minute. Okay, here's the lows that we swept. This represents Asian lows, but to be honest, guys, you don't even need to look at that. You don't even need to look at the sessions, right? You can clearly see that we took out these lows here. So boom, Here's our manipulation. Now understand, we need all of these confluences. Okay, so to confirm this area, before we buy from this area, we need all these confluences. So we got a manipulation. All right, do we have a clear impulsive move? What is a clear impulsive move? Guys, it's exactly what it sounds like, a clear impulsive move away from the manipulation. So if we see this market go and sweeps these lows here, we want the market to run away from that area, to show that it's an actual manipulation, to show that we actually have institutions. When you see impulsive movements from the market, that's when you know we had some type of institutional buying pressure there. So what we like to see here is strong movements away from that manipulation. So in this case right here, you can see we have this violent move towards the upside, and then we have another violent rally towards the upside. And you can see the market violently rallies away from here, not even coming back, not even touching it. This is good. Okay, we know that this area here, we definitely had some buying pressure, because look how the market is running away from that area. Okay, so our second rule is met, right? We have our manipulation, we have our clear impulsive move, and then our next would be imbalance. Okay, this imbalance is known as a fair value gap. You can call it inefficiency. It doesn't matter. I'm pretty sure you guys have heard about imbalance by now, from ICT or whoever your mentor is, whoever you're learning it from. I'm pretty sure you've heard about it. Fair value gap, imbalance, inefficiency. It's all the same thing. But this is another thing that we'd like to see, is a fair value gap, an imbalance. What that tells us is that we have a high chance that the market wants to come back to fill this imbalance right here, this fair value gap. And basically, to explain a fair value gap and what an imbalance is, guys, it's a 3 candlestick pattern. So it's basically a gap in the market. Okay, it's a 3 candlestick pattern. You see, we have one candlestick right here. We have this second candlestick that gives us that impulsive move. And a quick thing for you guys, a quick tip: usually when you have an impulsive move, you're gonna have an imbalance. Okay, usually when you have an impulsive move, you should see an imbalance. So another way to kind of clarify what an impulsive move is and to confirm is if you see an imbalance there. That means the market ran away from this area so fast that we didn't have time for sellers to get into this area, and that's a good thing. If we see an impulsive move away from our manipulation, that means that we had buyers here, aggressive buyers, that didn't allow sellers in this price point. That's basically what an imbalance is and what a gap is. It's when the market moves so fast in one direction that the other side did not get a chance to play. So what the market likes to do when we have these gaps, right? Identifying a gap right here, we have 1, 2, 3 candles, and you can see these candles right here are not touching each other, and we left that gap there. You can use the imbalance to verify your impulsive movement. So if you see an impulsive move with the imbalance, then you know that both of these confluences are checked off. So now we have manipulation, we have clear impulsive move, and we see the imbalance. The last thing and the most important thing is we need to break external structure. And when I say external structure, because I know some of you guys look at structure differently, this is why I showed you guys the way I look at structure. Because guys, if this high, right, when we were looking at our structure, right, if this high here led to this low, that means this area here where this manipulation happens needs to break a high. Okay, we need to break that high. We need to invalidate that high. So we need the break of structure. Okay, that is the last confluence here to confirm this A setup, is we need a change of character / break of structure / break of market structure. The reason why I put all 3 there, guys, is because I know people have different terms for break of structure. Some people call it break of market structure. Some people call it break of structure. It's all the same thing. You need the market to break structure. Where do we break structure? We break structure right here. So once we break this high here, this trade is confirmed. Okay, this area here is confirmed as our demand zone. So this is going to be our A setup, and basically we're going to take the whole area. So now that's our demand zone. That area right there, it followed all the rules. We have the manipulation, we have a clear impulsive move away, we have an imbalance, and we have a break of structure up here. Let's put BMS top. All right. And another confluence for those of you that understand Wyckoff, right, is you can see this here as a distribution. Remember I was telling you guys about distribution, seeing sellers. The fact that we have this area that invalidates the distribution gives me even more confluence, letting me know that there was definitely buyers here. Why do we know that? Because guys, remember, when we see a distribution that represents shorts, that represents selling orders, that means that institutions are taking profits, or some big players in the market are taking profits. So that means we had sellers here selling the market and taking profits going short. Okay. So what does that mean? That means if this area invalidates that clear distribution, that means that these sellers here are weak. What does that mean? That means these buyers here are stronger than these sellers, which is confirming that our trend is still bullish. It's confirming that buyers are still in control of the market. Okay. So now you have everything, right? You have your demand zone. We have a break of structure. Everything is confirmed. Now you just place your entry, guys. On the A setups, I just placed my entry on the open of that whole area. Stop loss at the low. Don't care about the stop loss, right? And another confluence for this trade as well is that we're building liquidity here, right? If you guys understand liquidity, we don't need all these extra things. Really, all you need is these to confirm the trade, but I'm giving you guys extra confluence in how and why that gives me more confidence on this trade, right? And that way, in your trades, you can actually add more confluences to these rules if you want to, or you can kind of spot which areas is going to be more high probability than others, right? So in this case right here, we have liquidity here, right? This is known as inducement, all right? Seeing this area, I know that the market is most likely going to be gravitated to come down here and raid these lows, right? To take out liquidity, to manipulate this area again to give us a reaction, and we have imbalance. So the reason why we know this area most likely is going to get filled and why the market will come back down here is because we have the imbalance down here that we know that the market likes to fill imbalance, and we have liquidity down here, so we know the market likes to take out liquidity. So now we have two magnets that's attracting price to the downside, okay? And we know that this right here is a demand zone, right? It's a high probability area because we confirmed that area, okay? So now we have our confluences. Now we can set our take profit. So for me, guys, my take profit is always a 1 to 3. Right, that is just my take profit. I always go 1 to 3. Now, for the sake of the video and just to look good on YouTube, we're gonna go for the whole. We're gonna go for the whole high. All right, for you guys. But I got taken out at a 1 to 3. Now we're gonna let the market play out. And I want you guys to see how this market reacts here. So immediately, you can see we came down here. We took out the liquidity and we filled the imbalance. Right. And look how the market moves, guys. So, straight to take profit. You see how when the market came back into that demand zone, look at the reaction from here. We got more impulses. That's just showing us that buyers are in control of this market. All right. So that is it, guys. That is the A setup here that we took on ACAD. That is the trade breakdown. I hope you guys got some useful knowledge from that. I will continue making videos like this and breaking down individual trades just to kind of show you guys the thought process, the rules, and everything like that, the confluences and why we take the trades that we take. Okay, so I will see you guys in the next one. Peace out.